All right, it's great to be back in the black hole of real estate. This is your host, Ron Wysakarski. And today, I want to spend quite a bit of time talking about the problem with owner financing. Very often we hear that people want to owner finance, and it's certainly convenient as a buyer to not have to go to the bank and avoid all the hassle and paperwork that goes along with it and the qualifications and everything on the big laundry list that a lender is going to ask you for. And somewhere along the way, I think there was either some bad information or bad videos or TV programs at 2 o'clock in the morning or something that caused people to think that it would be a really good idea to just have a strategy where we use other people's money and tiny payments or no down payments or cash back at closing and all these concoctions, which probably the person who sold the video or the book made some money and everybody else was kind of left holding the bag, so to speak. And the fact is that when you are owner financing as a buyer, you're really asking the seller to do you a favor. And when you think it through, you're trying to avoid a down payment, or maybe you've got less than perfect credit or some situation that causes you to think that it's easier, faster, and better for you to avoid banks and sell the whole paper. So let's tackle the first thing. Down payment. What do you think is a good down payment for owner financing? Well, I think most of them are about 20% down. And I know the illusion is that, we can work something out with the seller, and they'll just hold the bank and they'll trust us, and we'll give them $10,000 down on $300, and that'll be just fine. And the fact is, that's a lot of risk for that seller. And put yourself in their shoes for just a moment. $20,000 down payment, that's still relatively small, not a lot more than you would see if they were going FHA or maybe conventional. And if they had to take the property back, if you decided to stop paying for whatever reason, it's probably not enough to evict you and take the property back in court. They would actually lose money while you're staying there. So that's probably not in the best interest of a seller to do it with a super small down payment. And then we're talking about, what's the next thing up for bids? Interest rate, right? And you're thinking, I could get a preferred interest rate because that seller will make all that money off of my interest, and I'll pay even more than the purchase price because he gets to keep all that interest. That's the bank's position too. The bank's going to charge interest, the owner's going to charge interest. That's the cost of doing business if you don't have cash to buy the property. So there's going to be interest anywhere. And then you're thinking, why should they give you a discount? Maybe they've got a tax reason or some strategy, or they just love people and want to trust you. But the reality of it is, most owners that are going to own or finance are going to get a premium interest rate that is higher than the one you could get from the bank. And you're starting to think, why is the owner making all the rules over here? And why am I putting a big down payment and paying higher interest rate? That doesn't seem right. And if I can't deal with those terms, I'll just go to a bank. And this is the problem. If you're in the place that you're looking for owner financing, you probably can't go to a bank. There's something going on. Could be credit, could be down payment, could be terms, could be your job, provable income, something. There's something going on, because if you're just only in it for the convenience owner finance, you're probably better off going to a bank. Unless you're trying to avoid paperwork. And if you're trying to avoid something, that typically costs money to avoid things, and that's where this is going. I'm not saying that the sellers have all the power, but it's their money. So I guess they do have the power. Now, as a buyer, if you can go to a bank and get a better rate and better terms and better interest rates, I would do that. I would put up with the hassle of 30 days of mortgage to save thousands and thousands of dollars over the life of a loan. I think most people would too. But if you're asking the owner to do you a favor and hold the mortgage for you, I would expect that there's going to be some premiums paid to that person to do it. When would it make sense to actually owner finance on both sides. Let's suppose that the owner of the property has a tax situation where it would make sense to get the proceeds spread out over a number of years on an installment sale, where they get a certain amount of money every year and pay tax on it year by year, as opposed to selling it and getting all the money up front and being taxed heavily on it. Could change a tax bracket for them. There's a number of things that might be interesting for them to do that. So there are some people where it makes sense from the seller side to hold the paper. Now on the buyer side, there's a number of reasons. Look, if it gets you into the property and you have to pay a little extra interest and whatever down the road, most of these have a provision to refinance. Just read the paperwork. Maybe you get in today's rates and you pay a premium for a minute, but then you refinance it down the road. There's no prepayment penalty. Then the owner can get all of their money at that time, and accelerates, and that's you just pay it off. You get into a better situation with a different lender, with a lower rate, lower payment. It would all make sense. Sometimes you just need speed and ease. You got to make a deal quick, and maybe you won't qualify today, but you will next year. And do you want to rent one more year and have it all go out the window with zero return on investment? And I think it's where it begins to make sense to pay these premiums on the owner financing side. So they could ask for points, they can ask for higher interest rates, and then the terms. A lot of people will do what they call a 5-year balloon. Now, if you're not familiar with that, in essence, when you do the owner financing piece, you're saying that you'll pay the whole thing off in 5 years, which could be scary for some people and not scary for others. So if you're going to pay the whole thing off in 5 years, you think, oh my God, that payment's going to be astronomical. Well, what they do is they amortize it over 30 years, just like a 30-year mortgage. So if you think it through, you're making payments as if it's a 30-year mortgage, but it's all due and payable in 5. So those payments are not going to pay it off in 5 years. It's going to pay it off as if it was the first 5 years of a typical mortgage. So there will be some principal paid. The balance will come down. After 5 years, you have to sell it or refinance it, or twist the arm of the owner and say, look, I've been paying you all this interest, been paying on time, let's take it another 5 or 10 years. And that can happen. So the term piece, that is where these deals start to come together, because now we're getting something that makes sense to the seller and the buyer, that they both have a desire to delay taxes or delay the receipt of the money, or get into a property with the intent to refinance down to something lower a little bit down the road. Maybe just buying on today's dollars as opposed to buying in a couple of years when the prices are likely to be higher, and with no guarantee that inflation gets tamed or interest rates come down. It could be a pretty good thing for a buyer to get in and stop paying rent. So when we are in these situations, as much as we want to say, oh, owner finance never works out, people are doing it. See, they are. And I think more people would do it if they understood and had the right consulting piece in place that would allow them to see the greater good if they're in a situation where owner financing would actually help them or benefit them or put them in a better financial position than they would have been if they received all the money at closing if the buyer used a bank loan. So that's a really big piece on owner financing. There's absolutely other parts in there. The owner has a right to ask you to pull your credit, has a right to look at your income documents and your tax returns and your pay statements and see your bank statements, see if you can afford the property. They have a lot of rights in there. There's things that they can absolutely ask for, and that's how owner finance really works. It's rather uncomplicated. It works the same as a bank, it's just not a bank. The seller is not only a seller, but they're the bank, and they have the money and they'll create the terms. That's what I got for you today. I hope this helped you out with the owner financing piece. This is Ron Wysokarski for the Black Hole of Real Estate.